Welcome to Commercial Conversations Over Coffee, the show where two college dropouts turned real estate millionaires discuss all aspects of commercial real estate investing. Now, welcome your hosts, Tyler Cobble and apartment guy Bruce Peterson.
You know what? I'm just going to go ahead and start this show off with a bang. Bruce, I'm buying an 87 Lincoln limo and hiring a driver.
What the hell? Why an 87 Lincoln?
Why not?
I was in high school.
Oh, come on, man. Why not? So it's funny. I've been on a kick here recently of like, how efficient can I make myself with my time? And one of my buddies has an 87 Lincoln limo that he bought just to go out and have fun with. And I took a picture and shared it on my Instagram one day, and I was like, selling the Tesla and getting this. What do you guys think? You know, I'm basically gonna get this restored. I'm gonna hardwire an old telephone in there, and I'm gonna show up to deals like this. And it was like a complete joke. And of course, like everybody started DMing me. They were like, do it. You won't. And so I was like, you know what? I brought it up to Mark and we started talking about it. And I was like, okay, well, if we get all of the electronics and everything that I need, we get Wi-Fi in the back and I hire a driver, you can pay a driver $15 an hour, $18 an hour. So that's what, $35,000 a year. Then that means that I get back, probably an hour to 3 hours a day of sitting in the back of a car, which means I can do 1 to 3 hours more work, which means if I close one more deal, it pays for itself.
Exactly.
So,
are you watching $1 Million Listing LA and see the old cars that Flag drives? Is that what has you going?
No, I actually, it's funny. I never watch TV. But the first thing I thought of was Ryan Serhant, because he's had his driver forever. And I mean, it just honestly just makes sense. It's kind of funny, but I like the 87 Lincoln part of it. Like it's unpretentious. It's pretty East Nashville, honestly, and it's a classic. It's not like I'm going out and buying a Hummer limo and just showing up to to tours. It'd be a little ridiculous.
That's what you should do. You should get a Hummer limo with a hot tub in the back and a stripper pole and all kinds of stuff.
Does it come with the strippers?
Okay, wrong topic, wrong podcast. My wife's in the other room.
Hey, you brought it up, man. You brought it up.
Stripper pole. You went.
What does that imply? What is it? You use a stripper? Like, is that
on a stripper pole?
Oh yeah, that's fair. Is that your choice of workout?
Yeah, I've actually got pictures of me dancing on a stripper pole in a party limo.
Oh my gosh, that's right. Well, hey, you should just leak those photos yourself, because then no one else can ever say anything bad. It's like, you can't take this guy down.
Yep.
Yeah, we should. Hey, we are in Nashville. Maybe I should get like an F-350 stretch. That's the way to go.
Yeah.
Put some.
Texas, you would have to get steer horns on the front somehow.
I was gonna say, you got to put some Longhorns on the front.
Yep.
That'd be awesome. But yeah, I'm actually really excited about that. It's been fun talking about like how much that will add to what we're doing. So anyway, how you doing?
Dude, I'm good. We're cold. It's about to get down to almost 0 degrees in Austin, Texas, which for us is ridiculously cold. It's like decades old cold snap. I don't remember it getting this cold almost at all, maybe. I mean, I'm sure it has. I've been in Texas about 48 years. I've been in Austin for a little over 30, but I don't remember anything this cold. So we're just trying to stay warm. We've got ice on everything. So it's good, but yeah, we're definitely sheltered in place now.
How is that even possible? 0 degrees? I mean, I guess that's the ice storm that they're talking about is coming up this way, right?
Yeah, and again, we're close. The last update I saw, we're looking at 4 or 5 degrees, which again for Austin is just insanely cold. We don't get into the 20s very often. We'll get there a few times a year. Below the 20s, maybe once every 5 or 10 years, but now we're going to be getting close to 0, it sounds like. So, yay, I'm about out of firewood, so I need to go buy some more firewood. I love burning fires. Fire. But I'm just about enough firewood right now, so I got to go get some more.
Well, I mean, I'm jealous of that, man, because you guys have mesquite, which nothing smells quite like a mesquite fire in the winter. I mean, that's it. That literally, it just reminds me of being a child and going and visiting my dad on the farm. That's a great wood.
Yeah, I love burn fires. And one benefit to Amazon in my life now, we get packages all the time, like everybody does. It, I get sent the best kindling in the world. There's all kinds of good packing material. I try not to burn anything with colors, anything that's a foil kind of reflective thing. But if it's just plain cardboard or cardboard packing or some of that egg crate kind of packing, not the peanut stuff, that's styrofoam. But man, I get all kinds of kindling. So another benefit of ordering on Amazon.
Welcome to the Bruce and Tyler Variety Show, where we talk about 87 Lincolns, strippers, firewood, and real estate occasionally.
Right. So let's bring this back to topic before we get into our actual topic today. Something happened right before we got on that we got reached out to by somebody that we've been helping. They are a client of ours. And so it's not altruism, right? We're not helping just to be helping, but we're doing the best job we can for these guys. They've got a great project. They're good people. They're just, maybe it's time for them to move on for whatever reason. And they reached out to us and said, hey, you've been great for us. You've done more than a normal management company would for us. You've been invaluable to us. We're thinking about maybe offloading this deal a little sooner than we thought, but you guys have any interest? So by providing value to others, yes, we're getting compensated as a management company, but trust me, we're doing tremendously more than a typical management company would because we like these guys.
Yeah.
And again, they are clients, so we want to always go above and beyond. So this may have, created a business opportunity for us outside of the management company. So, treat every relationship like it's gold, because it could be, even if it's not the best relationship in the world, try to preserve it, try not to burn bridges, take care of those connections, because you never know how they're going to turn out.
Yeah, that's a pretty big deal, right? I mean, we're getting first look at an apartment building in Nashville because of that. And I think that, it's honestly, this kind of case happens all the time, right? I mean, it's basically a project that was just too large, and they thought they could take it on, and hadn't done anything like it before. And great idea. I mean, we love the idea. That's why we're very interested in buying the project. But because we took it the right way and we handled it the right way, yeah, I mean, we're getting a great opportunity. It's, I tell everybody, like, property managers, brokers, and title agents, they are the underworld of commercial real estate. They know everything going on before anybody else does. So if you're in any of those three industries, make sure you're building relationships, because that can be invaluable.
See the intangible side of it, that, we started a management company because we wanted to control our own destiny when it came to property management. That's ultimately why we started it. But then we started the third party manage for other people. And then that is generating extra revenue streams for us. But the biggest thing there for me professionally is it gives me more opportunity to grow the organization, the ability to hire more and better people, and then to promote the people from within that are in our company that deserve it. So we're trying to provide upward mobility for the folks that want it within our organization. But again, this side benefit now, it sounds like, there's a decent shot at being able to pick this deal up. We might not be able to come to terms, and it's totally fine, but it's just the thought that, it's been presented to us. And that in fact, that wouldn't have happened had we not had our own management company.
No, it definitely wouldn't have happened. I mean, we were in the right spot at the right time. And it's because, we kind of advised these guys before they acquired the property. They ended up hiring another property management company before we were brought in, just because they wanted something that was more established in Nashville. We have, 1,100 units under management right now, but it's Bruce's portfolio in Austin. And so, it's our first multifamily deal in Nashville. So understandably, we probably would have gone with somebody else too. But we were always there, willing to help, and at no cost. I mean, every time they had any questions, they called me, and we talked about it. You mentioned something earlier that I want to bring up: income streams. How many income streams do you think you have?
Oh, good Lord. Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We're probably about 14 to 15 income streams.
I love that you were like, oh, good Lord. I have no idea. Let me sit here and count how many income streams I have. That's one of those things that when you're first getting started in the industry, you don't fully appreciate how, because you're like, I got to go get a job. I got to make money. Right. But I mean, you and I don't have 14 or 15. I've probably got 7 or 9. But that means that, if I lose one job in quotes, I have other ways of making money. I'm not fully reliant on that one direction. I mean, that's incredibly important as a real estate investor.
Right. I actually forgot about all the education and the book sales and stuff. So, those aren't really large, but they're accretive, right? They add to my bottom line. So I'm probably closer to 20, and I'm going to mess this one up, I'm sure. It's either the average billionaire or the average millionaire has 7 income streams, 7 sources of income. Again, who was it? Not Dana Carvey, Dumb and Dumber. Who was that? Jim Carrey. One of his big commencement speeches, he talked about how, his dad got laid off of a very stable job after 20 to 25 years. He never wanted to take any chances. He wanted the safe life. He got laid off from being, I think he was an accountant.
He was an accountant,
after 20 to 25 years. And he's thinking, whoa, what happened? This was the safe path, right? This was the conservative path that nothing could go wrong. I'm working for somebody else. I can't lose my company. Yeah, think about that, And so his quote was something along the lines of, you can fail at doing crap you hate. You may as well try something you love. Get out there. And I talk about this crap all the time, and people are probably tired of hearing it, but it's okay. But again, the average millionaire or billionaire has 7 or more income streams. So to your point, if I lose a property, I sell a property, that is, or, I don't have any construction income for a while because maybe COVID shuts everything down. I still have lots of other things contributing to our income. I'm getting book sales because I wrote a book. I'm getting educational course sales because we've got our own educational platform online. So yeah, every time you turn around, there's another small piece coming in. Those small pieces add up to very, very large pieces, but it keeps us diversified somewhat, and it keeps us financially sound.
Yeah, I mean, let's break down one deal, right? So, on my end, I own a commercial real estate brokerage. They typically source our deals. Bruce and I own the property management company together, and then I own a development company. So we go in and we buy a deal. The Cobble Group gets paid a commission. We may or may not take an acquisition fee as the asset managers. We typically don't. Sometimes there are cases where we will. We get paid an asset management fee. We get paid a property manager fee through the property management company, Parasol. If it is a development, I get paid a development fee. If there's any leasing, there's leasing commissions. There's another fee there. If there's a disposition, there's probably a sales commission to the brokerage. There's probably a dispo fee to the asset managers. I mean, is there anything else that I'm missing on one? I'm sure there is on one deal. I mean, look at all those different ways to make money on one deal.
Well, right. And, I don't want people to hear that and go, you greedy bastards, right? They're all legit. It's just the way this industry works. All of those fees still get the end investor, the limited partner. They still get the return that those people are looking for. So it's not like we're doing anything weird. We're not trying to take advantage. We're not gouging anybody. It's the way the industry works. And, you're talking about all these other ways that you have to monetize these deals through your brokerage, us through our management company, and the asset management company. Well, you just have to be upfront about that, right? So when we do a new deal, when we bring a new investment to market, part of the explaining how it's going to work is we divulge all the different, potential conflicts of interest. We say that, look, an affiliate company of ours will do the management. An affiliate company of ours will do the asset management. An affiliate company of ours will do the construction management. We put it all on the table. For you, I'm sure you disclose that, look, I will be the broker on this deal, so I'll get a small commission on it. But we disclose all that, so that way all of our investors have all the information they need to make the right decision. If I present them with a 15% return and their threshold is only 10, but they're not really comfortable with the fact that my management company is going to manage the investment we're in together and you get a commission from buying and selling, they might not feel comfortable with that, and that's totally okay. That's going to happen.
This deal isn't for them.
Uncomfortable with something. Exactly. But you got to put it out there, be upfront, be transparent. Don't hide anything, because eventually that stuff's probably going to come out in some way anyways. Hey, I think we need to fire the management company because they're not doing a good job. I should have told you I am the management company.
That's
Stuff
me.
like that could come up. Yeah, it could come up, right? So just
Yeah.
be careful and divulge everything. But yeah, that's one of the beauties of this. Now, most people will get into what we're doing and they'll just take the promote and be happy with that, because the promote, that's pretty substantial. But they don't want really all the other headache, because really the management company piece of it is the most difficult part of all of it in my world. Now, I'm learning development with you on our first 2 deals here, but that's probably just as difficult, or maybe even more so than the management company. But a traditional person that is being taught how to do syndications, the hardest part of all the deal is the day-to-day operation. So most people don't want to deal with it. Totally fine. It's just there are multiple ways you can monetize these things, though.
Yeah, and the day-to-day operations is just as important as buying right. Because if you come in and you operate the investment poorly, it doesn't matter how great of an investment it is, you could still lose your ass. And one thing too, I mean, we charge market rates on all these fees because somebody's got to do the leasing. Somebody's got to do the property management. And, we do have in there like, look, if the property management's not performing, we will fire ourselves and we will hire somebody else, because as asset managers and investors in the deal, it makes sense for us to hire the best group for the project. And, it would be a conflict of interest if we kept ourselves, like we would actually be forcing ourselves to lose money if we just were like, no, we're going to keep doing it. It doesn't make any sense. And, the thing is too, like I said, we're going to have to hire somebody to do this anyway. If you're an architect and you're syndicating your own deals, guess what? You can take an architectural fee, right? Because you're going to be giving yourself the business to do the deal anyway. If you're a general contractor, you're going to get paid to do the GC work on that project. So, it's like we don't own an HVAC company, but somebody's going to get paid to do the HVAC, right? So those fees are going somewhere. It's not like these are just fees that we're creating out of nowhere. I mean, they're all typical in these deals.
Right. So that brings up a point that a lot of people getting into this industry on the syndicating side, they're like, oh, the deal doesn't work. But if I'm going to be the management company, so to speak, so I just won't charge myself, I won't charge the company a management fee for me, right? Well, that's fine. That's great. But to Tyler's point now, let's say you get in over your head and you think, oh, I don't have the bandwidth to do this. I'm not as qualified as I thought maybe I would be. I don't want to do it anymore. Well, I didn't underwrite paying somebody a 3 to 5, maybe 10% management fee.
That's
so now
a problem.
What are you going to do? It's going to crush your returns if you didn't account for it. So you need to pay yourself for the legitimate roles you're providing to the company. But like you said, they need to be market rate. Don't gouge the property for one thing. If in that market, your 48 or 50 unit property would typically be a 4 to 5% management fee if you went to another company to do it, don't charge your partnership 10% because you can. That's a bullshit thing to do. It will come back to bite you. Somebody will figure it out eventually, I bet. And you're going to look like a greedy, I almost said a bad word. You're going to look like a very greedy person, and it's not going to end well. So charge market rates. Don't gouge people. But charging market rates also means don't charge a lower than market rate. Because again, if I become mentally incapacitated, something happens to my management company, I have to shut it down for some reason, let's say. Well, I have to be able to go hire somebody. And if I haven't allotted enough money for that management company fee, well, now our returns are going to get hit. So that was a really good point you made.
Yeah, you'll be in a lot of trouble.
Yep.
And the way that I always approach these type of scenarios is, okay, if I'm having to give a deposition one day and in front of the SEC, and they ask me, was I looking out for my investors' best interests? If you come in and you charge a 10% property management fee, or you charge 10% leasing fees, or whatever, anything that's well above market, how are you going to be able to sit there and honestly say, I was looking out for my investors' best interests? I mean, at the end of the day, that is number one, right? Like, I mean, there are plenty of projects where I've said, no, I'm actually not the best representative to do the real estate side of things. Like when I did the 42 unit townhome development, I did not want to touch the sales. I didn't want to touch it because I do commercial real estate, right? I do not do residential real estate. I have no idea how that side of things works. I mean, I do. I've got an idea, but like there's a lot of details that I don't know and I wouldn't be good at it. And so, of course, when we went into that project, we hired a whole other team, a residential specific team to come in and do that project. So it's good to keep that in mind too, that, just because you can collect the fees doesn't mean that you always should if it's not in your investor's best interests.
I agree with that completely. So what's our topic today? I forget.
So today we are talking about how much capital should you actually raise for your deals. So we've talked about raising capital. We've talked about syndication. One thing, when Bruce and I first got started working together, he was showing me how to underwrite deals. And, me being the green kid that I was at the time, I thought, here's a $1 million deal. The bank needs 20% down. You just need $200,000 and you can get it. And that is not quite the case. So let's talk about how much capital you actually need to raise, one, and two, how much you need to overraise, because things happen. And so I think it's really important to approach it from both ways. So Bruce, when you're approaching your deals, let's say it's a multifamily deal and it's value add, because that's probably the most common. Ooh, look at you whipping out the pen, man.
Notes here to make sure I don't miss any steps.
So let's say you're doing a value add commercial deal, because I would imagine most of our listeners are probably along that vein, right? They're looking at value add commercial properties. So let's talk about, I guess, one, lender requirements. What can you expect from a lender in terms of a down payment? And then what are you going to actually bring to the table? I mean, how much cash do you need to close? And then let's cover some of the other expenses that you'll need as well.
Okay, so I'll break it down. There are four main things to talk about here, and what goes into your cash raise. And I just wrote an article about it on LinkedIn, so look me up, Bruce Peterson on SEN on LinkedIn.
I saw that.
If you don't catch all this. Yeah, so, I don't know if it's a big problem, but it's a big misunderstanding. I'll have people do exactly what you did. Well, how do I raise the 20% down payment I need for this $1 million purchase? First of all, you need a hell of a lot more than that. So
yeah,
I thought it was important to write it down. Write the article. But so you're going to have down payment, rehab, operating capital, which will consist of true operating capital and negative carry. A lot of people don't think about negative carry, but I'm going to break all these things down. But then you also have closing costs.
Let's also break down, because I didn't understand this, right? Because I came from the commercial world. In multifamily, you have financed construction expenses and non-financed construction expenses, or what do you call them?
Non-capitalized. Right?
Yeah.
Yep. So we're going to break all these down. So let's start with the down payment, right? So everybody thinks that's all I need. Now, that's not all you need, first of all, but it is going to be the biggest portion of what you need almost always. If you have a huge value add project that you're going to spend tons and tons and tons of money on rehabbing, okay, it might end up running more, but it's almost always going to be the biggest chunk devoted to down payment. So very simply, we all know this, right? If you're going to go out and get $1 million loan to buy a property, well, you're going to have to come up with 20% down on average to buy like a single family rent home. Well, you have the exact same thing going on when you buy an apartment complex. You're going to get a $1 million loan, and the bank is going to say, look, I'll give you the loan, but you have to have some skin in the game. So I'm not going to finance the entire project to you. You have to come out of pocket some equity, and it's usually going to be 20 to 40%. In the market that we're in right now, I'm usually seeing 25 to 35%. So let's call it 30%. Back when I got started, you could almost always get a 20% down payment loan, which is called an 80 LTV, loan to value, right? So you would get 80% loan proceeds on the purchase, so you'd have to come out of pocket 20%. Again, today's market, I'm seeing more along the lines of 30%. That will vary based on the area of the country, the lender you use, your background as an owner, your track record, your balance sheet, your credit score. There's a lot that goes into that. So if there are two people going for the same type of loan on the same property, but one guy has a 350 credit score, whatever the lowest is, first of all, they're probably not going to qualify. So that's probably a bad example. But let's say they have a 600 credit score and I have an 800. I'm probably going to get a better loan, which could mean less money down. It's probably going to definitely affect the interest rate. But there are things that are going to affect how much that you have to come out of pocket for this down payment. And a lot of it is variable. So what I'm seeing on average, though, right now is 30%. So that's the down payment. That's that first piece.
So why would you see such a I mean, because the difference in 20 and 30% is a lot of money. Why do you think that you're seeing closer to 30% down payments right now?
Because prices have gone up dramatically. So they are still willing to lend on these deals, but since they've gotten so expensive, your loan proceeds usually are going to be constrained by what's called your DSCR, which is your debt service coverage ratio. What that is it says your top line profit, right? Your NOI, net operating income. That's all of your operating income minus all of your operating expenses, whatever's left over. That's called your NOI or your net operating income. That profit needs to be substantial enough for the bank or the lender to feel comfortable lending you money. Most bankers, most lenders, Fannie Mae, Freddie Mac, regional banks, they're going to have about a 125 DSCR right now, meaning if I'm going to have a loan payment for the year of $100,000, now it's going to be paid monthly, but let's say your annual debt service, your principal and interest is $100,000. If you have to hit a 125 DSCR, debt service coverage ratio, you have to have $125,000 in profit for that year to be able to support that loan payment, is what they're thinking. I'm going to close some of my tabs here. I'm freezing on my video. So that's going to be a lot of the determining factor as to how much they're willing to lend to you. It's all about profit. The more you're willing to pay for that profit, the lower the loan to value will be. So the less percent they're willing to lend to you on that given project, because you're paying more for the same profit. So the more you pay for that profit, the more it's going to impact your DSCR, and the more it's going to impact your loan proceeds, which then will drive up your down payment. That's the biggest determining factor that I see. Now, you're going to have differences within asset classes too, meaning, an A property, B property, C property, D property. The higher up you go, the more you're going to have to pay up for that same profit because there's less risk. So you're going to have to come up with a larger down payment on those.
And that makes sense. I mean, most commercial or multifamily loans are not just hey, we'll give you a 75% LTC. It's, no, it's 75% LTC or a 1.25x, DSCR, whichever's lower. That way that they cap out how much money they're going to be giving you and making sure that they're still protected. So that's probably why that's starting to pop up. That makes sense. You're paying more for the same income because cap rates have gotten so compressed. Right. And banks still want to make sure that they are protected enough so that if they have to foreclose on you, they can flip the property and make their money back and hopefully make a profit.
Exactly. So let's talk about something you threw out there, LTC. I said LTV, right? So there is a difference. What is the difference? They're not synonymous. They're not the same. LTC is loan to cost. LTV is loan to value. A loan to value means I'm going to pay $10 million to buy a property. I'm going to get an 80% loan to buy that property. That's a loan to the value of the property. It's a loan to value. A loan to cost will mean, what is the cost to buy that property? You have the purchase price. You have rehab. They may be willing to roll into the loan. They may even be able to roll in your closing costs. Those are all the costs to buy that property. The value of the property that you're buying is $10 million. What you add in all your costs, maybe it's a $12 million cost to buy that $10 million asset. So that's where the LTC comes in. If you have an 80 LTC, that is different than an 80 LTV. I just wanted to make sure people understood that.
Yeah, they're very different. And I think that it depends on the kind of asset that you're playing in, right? Like if you're doing a heavy value add, which is that's the sandbox that I tend to play in, we're focused on LTC because banks are not going to be able to value the property, any higher because there's more risk, right? So they want to make sure that they're more protected, so they'll do a loan to cost instead of a loan to value. If you're buying a stabilized asset that has income coming in, they'll do more of an LTV because maybe you just happen to get a really good deal on something and it's actually more valuable than what you're paying for it. So, they also have lower risk, right? At the end of the day, it's all about the risk profile.
Exactly. And so so we've pretty much covered loan to value, the down payment, all that pretty thoroughly. So the next piece of it is going to be your closing costs. And I like to run closing costs and startup costs together because not everything that to me goes in this bucket. And really, it doesn't matter what bucket you put these different pieces in. You just have to make sure you account for them. But my startup costs would be your typical closing costs. It would be the loan application fee if you have one. Fannie and Freddie always have a loan application fee, but not all local banks will have those. You'll have a loan origination fee. You'll have points, maybe if you're used to points in the single family world. Those are your closing costs. The things that I actually add in there also are all the fees paid to my personal attorneys. I have a real estate attorney. I have a syndication attorney because I'm doing these as syndications. Those are part of the closing cost / startup costs. I also roll in the due diligence inspections. If you have somebody come out to inspect the roofs and they charge you for that, that's part of that. You'll have those guys. The foundation company will usually charge you. The wood destroying insects company will charge you. The pool inspector may charge you. The plumbing company will probably charge you. So I put all that in there. I also put all of my utility deposits in that bucket, and my prepaid insurance, right? Because usually you'll have to come up with 1 year's prepaid insurance. So that's what goes into that number. On average, I usually see 3 to 4% on that. The larger you go, a lot of those fees are fixed. So the higher your purchase price on the same fixed cost for some of these items, the lower your percentage overall for the closing costs will be. So the deals that I'm buying are usually $20 million. Around that range. So I'm going to pay about 1 to 2% for my closing and startup costs. I think a good rule of thumb, your first one out, a smaller property, is probably going to be about 3 to 4%. It could be as high as 5 or 6% if you're buying a 5 to maybe a 10 unit property. But that's what the closing costs are. We've talked about the down payment, 20 to 30%. In this market, I'm usually seeing 30%. Closing costs, if you're going to kind of try to pull up a rule of thumb, could be higher or lower, but the rule of thumb I would use is probably 3%.
Is that on closing costs, or is that on just all other expenses?
No, that's closing costs and startup costs.
Okay. So would you consider that your pursuit costs? Like you'd throw that in as...
Well, no, not really, because that's for the people that charge acquisition fees. That's what that's for. The acquisition fee is to cover the pursuit costs, meaning, you might have to fly around the country to do a few tours. You might tour, 10 different properties and have some pursuit costs trying to get those properties bought before you get that last one finally closed on. So I don't really put my pursuit costs there. Those are just costs out of my pocket. I don't do anything with those. If I wanted to try to be reimbursed for those, I could. Obviously, it's a legitimate thing, and most people will do it. But that's why most people charge acquisition fees, and I don't charge acquisition fees.
So you don't have the company reimburse you for any of your pursuit costs? Like obviously like surveys, environmental, that kind of stuff, you're having the company reimburse. But you're just saying like travel and stuff like that, you don't have
travel, my time spent underwriting, things like that. No, I don't charge for that. What I do charge for, yes. I personally, as a syndicator, will put up the 1% earnest money fee. I'll be reimbursed for that. Well, I'm not going to be reimbursed for that. That's going to get rolled into the purchase price of the property. But all the other fees.
On a deal like this, that's $200,000, right? $20 million, that's $200,000 that you have to be prepared to come out of pocket for.
Exactly. But the reimbursable ones would be the syndication attorney. If you have to pay up front because you don't have a relationship with your real estate attorney, well, you'll have to front that also. So there are a lot of these fronted fees, all the due diligence inspections, which could easily run you $3,000 to $5,000. That's an upfront fee that's going to come out of my pocket as the syndicator. But yes, I will be reimbursed for those once we close the deal. All the money's in the bank account. We close the deal, then I submit invoices. I can't get reimbursed if I can't present invoices or receipts, but I will present them. Bookkeeping will then cut a check back to me for all the fronted costs, because those costs truly are the costs to the company.
Right.
But since I was in a money raise situation, I didn't have the funds raised that I could just deploy for all these things, so I had to cover them out of my own pocket and be reimbursed.
Yeah. I mean, I'm sure Steph is going to make sure that you're turning in your receipts and being a diligent asset manager. So pursuit costs, I mean, as a percentage, what would you say is, obviously it's going to depend, because you'll have some, as a percent on a smaller deal, you'll have higher pursuit costs than you would on a $20 million deal. So you're coming out of pocket 1% on the earnest money. you're going to spend 15 to 20 grand on a syndication attorney. You could end up spending 10 to 15 grand, maybe more, on a real estate attorney, depending on what kind of project it is. That's 1.5%, give or take, if we're looking at a $20 million deal. You've probably got another, I'd say, 50 grand in miscellaneous. So maybe we're closer to, would you say 2% is probably a good number to look at as far as the whole overall global pursuit costs?
You can, based on the way you broke it down, yes. But remember, the earnest money is not a cost. The earnest money is part of the purchase price that you have to put up front. So the way you did it, rolling it all together, yeah, you're looking at about 2% probably. That's fair. But if you strip out the earnest money, because again, that just gets rolled into the purchase price, you're probably closer to 1%.
Yeah, I'm just trying to help somebody who's never done their first deal. They're trying to figure out how much capital they have to raise for their project, but also like how much do I have to come out of pocket to do this, to make this happen first?
Exactly.
And give them so 2% is probably a good number. So I mean, if you're looking at, a $10 million deal, 200 grand is probably what you're going to be coming out of pocket for. So if you don't have the cash on hand to outlay $200,000 before you've closed the deal and gotten reimbursed on a portion of that, maybe you need to start smaller. Is kind of what I'm getting at. So, when you're going through a cash raise, how much do you overraise?
Well, I'll usually do hundreds of thousands of dollars. Now, remember, I'm raising $6 to $8 million on average, so a couple $100,000 is not that big a deal on a $20 million project. So it sounds like a ton, but it's not that much. So where I tend to really overraise is in the rehab or the operating capital. So those are the two pieces we haven't talked about yet. But that's where I'll usually overraise to make sure I don't get stuck not having raised enough money. So, we talked about the closing costs, the down payment. So the next thing with that in mind is we'll talk about the rehab. And you brought this up a little bit earlier, but the rehab, that's the money you're going to spend to pretty the place up, to take care of some deferred maintenance. It's all the stuff you're going to spend on the property itself after you close. Now, we talked about LTC and LTV. LTC is loan to cost. In multifamily, what we almost always face, if I want to roll rehab dollars into my loan, your lender will usually let you do that, but only for things that are value add. So if they see if you spend this much money on rehab in a value add sense, it will turn into additional profit and value in the property. So it's making the deal safer for them ultimately because you're creating more value. They will not.
So what is considered value add and what is not considered value add?
So curb appeal, unit upgrades, parking structures, things like that. Deferred maintenance is the non-value add. So if you have a failing paint job, if you have big potholes everywhere, if you have sagging foundations, roofs are in terrible shape, that's deferred maintenance. And it's deferred meaning that the previous ownership did not take care of the asset. They're not going to lend you money just to make the property proper, if you will, just to bring back up to standard. They're only going to lend you money for the rehab portion that's going to make the property more valuable. So when you have to address the deferred maintenance stuff, that's not making it more valuable. That's preserving the asset to make sure it doesn't fall to the ground. That's it.
That's really interesting because in commercial real estate, that's considered value add. If you're coming in and repainting the building and you're redoing the parking lot, like all of that stuff adds value because, I don't know. I would think that would add value in multifamily, but I guess they just don't look at it that way.
Right. Now, if you're going to paint only because you don't like the color, well, maybe you could, this is all an art. It's not a science. There's not boxes that you check and there's a book that you go by. That's why you use your lender. Well, I like to use mortgage brokers, and we've talked about that before. But so my mortgage broker can go back and say, look, traditionally, exterior paint, you're right, is not considered value add. But there's nothing wrong with this paint job. It's actually pristine. There is absolutely zero wood rot on the entire property. They're only painting the property because it's not a current color. It might be baby shit green. It might be cute green, harvest gold, that kind of thing. And that's not appealing. People don't want to live in an ugly place. So
it is pretty amazing how many investors choose colors like that. You look at these buildings, you're like, what were you thinking? Like, you spent money to make the building look like that.
Yeah, that was a concerted effort on your part to make it look ugly. Was that the
Yeah.
goal? How ugly can I make this? Because now it's a challenge to see, can I still lease it up
That's,
if it looks
that's
like hell?
right. Can we still raise rents? Let's see. Like, yeah, we don't need the
Right. So,
additional challenge.
yeah, so hopefully that helps people understand if it's money being brought, if it's money that you have to spend to repair the property, well, again, that's deferred maintenance in multifamily. They're not going to lend you that money. So you're going to have to bring that money in your cash raise. So let's say, between the roof and the foundations and the parking lot, all those things, it's going to add up to $300,000-$400,000. Well, you have to raise that money. If it's for value add projects, you submit your list of proposed value add projects with some bids and say, look, this is what I'm going to do to the property after we buy it. It makes the lender very often more willing to lend to you because they see you're willing to put a lot of money into the deal to make it a better project, to lure better and more tenants to it, to make it more profitable. So they're more likely to give you the loan usually, but they will lend you for that stuff. They will not lend to you to fix it and to repair the property.
It's interesting too when you break down the difference between, commercial multifamily and then you even get into development. I mean, development, you're looking at 15 to 20% down for acquisition and development loans. So they actually wrap in, a development loan is wrapped all around. It takes in everything into account. So acquisition, obviously, so you're buying the dirt, and then development. So that's all of your development costs and your construction for doing that project. Now, typically for an A&D loan, you're going to be paying a higher interest rate because it's inherently more risky. You are building something from the ground up. Time out. What's up?
A&D loan. You got to remember, you got to explain this stuff as we go because people
I
don't know what the hell you're talking
said acquisition and development. Okay, so A&D means acquisition and development. Thank you.
I'm
So
probably asleep. Go ahead.
yeah, it's okay. You're on your first cup of coffee, so probably your third, really. So A&D loans, they typically have a higher interest rate because they are inherently more risky, right? You're developing from the ground up. There's no income coming in. And if, again, we go back to the risk profile. If a bank has to step in halfway through a development and take that over, it's going to be a lot tougher for them to sell to the next guy because it can be tough for a developer to just step in and, it's like a lot of contractors don't like finishing somebody else's work because they don't know really where it was left off, and there's a whole lot of issues there.
Well,
But
they have their own vision, and they're having to basically inherit somebody else's vision. They might think
right,
that's a stupid idea, but we're too far down the path to change now. I can't really pivot anymore, so I get that completely.
yeah, exactly. This, you've already poured the foundations. So if I want to build a multifamily apartment complex and you built a sports arena, probably not a fit for me. There's very few people that would be willing to step in and finish that. They're also shorter term loans, right? I mean, you can have some A&D loans that go to perm, which means they are a permanent, long term loan. But typically you don't want that because you're a higher interest rate anyway. And so, these loans will be, 18 to 24 months, maybe longer. It just depends on how long you think it depends on how big the deal is. But, you kind of want to get them stabilized and refinanced into long-term debt as quickly as you can, which is what we're planning on doing at the Provisionary. We're planning on that being a 4-year process. And as soon as that is, we're doing construction to perm just so that we don't have to worry about refinancing before there's any income coming in. But as soon as the property is stabilized, we're going to refinance, put better debt terms on it, and then hold the property.
Right. Yeah. So it is a totally different world between multifamily and more of a true commercial, especially when you're dealing with development. So let me finish up on rehab, though. So we talked about LTC, LTV, what is considered value add, what is considered deferred maintenance. So let's just say, let me try to give you some parameters and some rules of thumb. A very light rehab in multifamily is going to be somewhere between $1,000 and $3,000 per door. There's not a lot wrong with it. There's very little deferred maintenance. You don't have a lot of value add stuff that you need to do to it either because maybe the landscaping is pristine, all the signage is great, the leasing office has just been remodeled by the previous ownership. So there's not a whole lot to do. For the most part, you take it over, you run it, and you start cash flowing it. Now, when you start to get into like kind of a more mid-range where you've got maybe a few things that you need to address on some deferred maintenance, but not a ton. You might have to, paint the exterior, which maybe doesn't sound like a lot, but I just painted two exteriors. One was $200,000, another one was $125,000. So they can get very, very expensive very quickly. But I'm painting properties with 20 to 30 buildings, so got to keep that in perspective also. But so it's something that maybe you have one major project, but the roofs look good, the parking lot looks good, the foundations look good. And then you're going to raise a little bit of money for some unit upgrades and maybe pretty up some of the landscaping because it's not in bad shape, but there are a few areas that you want to kind of clean up a little bit, make it a little nicer. So now you're looking maybe $3,000 to $6,000, maybe $7,000. But that's starting to get on the little of the heavy side. And then if you're going to take over something that is just beat to hell, it's in a bad part of the town, maybe it's boarded up. There's tons of deferred maintenance. The previous ownership, maybe they didn't even have a loan on it, so they didn't have a lender standing over them all the time. You need to fix these things on an annual basis. So they just let it go to crap, right? So roofs are in terrible shape. Windows are busted or boarded up. You have potholes everywhere. You have foundations sagging and, parts of like retaining walls falling over. And you want to reposition the entire property and start rehabbing all the units and spending maybe, $3,000 to $5,000 to upgrade a unit to get an extra $100 to $200 in rent. Now you're talking, 8 to 10. It could even be as much as $15,000 to $20,000 per door. Now, where a lot of people get confused too is they say $15,000 to $20,000 per door. You mean I'm going to put $15,000 to $20,000 into each unit? No. It's the total amount of rehab dollars spent divided by the number of units. So some of those rehab dollars are going to go to the very expensive projects of the parking lot, the foundation, the roof, the paint, things like that. So don't get that confused either. That $15,000 to $20,000 is not going into the units. It's just that total amount divided by the total number of doors. So again, light, maybe 1,000 to 3,000, could be 4. Mid-range, rehab lift would be 4 to 7 or 8, and then really anything 8 and above. And again, there's really no limit to this. It could easily be $10,000 to $20,000 depending on how pretty you want to make it. You can over rehab a project. Remember that too. Don't over rehab it compared to your market too much, because then it's just money that you're not going to get a benefit from. But so 1 to 4, let's say 4 to 8, and then 8 and up is a heavy rehab.
Well, so you bring up a good point with the don't over rehab it. I mean, one thing that I've heard that's like, it seems to me like an unspoken rule amongst multifamily syndicators is leave meat on the bone for the next guy. Is that something that when you're looking at a project, you're conscientious of, and you go, here are, there's 10 things that really need to be changed on this property. We're going to do 5.
So yeah, that's a really good point, because everybody goes, well, that doesn't make any sense. You want it to be as profitable as possible. There are 2 things going on every project that you buy. Well, almost everyone. If you plan on holding it for 4 to 7 years, you're telling me you're going to sell it at some point. So you want it to be as profitable as you can, but you also want to sell it for as much as you can. If you upgrade every unit, if you improve every single possible thing that you could, I mean, what's in it for the next guy? There's a good cash flow stream, sure, but there's no upside for them because they can't keep, upgrading units. You've already upgraded all the units. So my rule of thumb, I don't want to really upgrade more than 40 to maybe 50% of the units on the property, period. And so that's what I'll underwrite. Now, I could go all 100% if I'm going to hold the property for 40 years as a family. Right? We don't have investors. We're going to buy it by ourselves. We don't ever plan to sell this thing. Well, then yes, I would upgrade everything because I want it to be as profitable as possible, as quickly as possible. But if I have an eye towards sale, in, again, 3 to 5, 5 to 7, 7 to 10 years, I need to have some story to tell the potential buyer to say, hey, not only are you buying this income stream, but look at all the extra profit that you can increase this by. So yeah, I won't rehab every unit at all. I will leave some money on the table because that will benefit me when I go to sell it.
Yeah, it makes sense, right? I mean, like I said, meat on the bone. The next guy's got to have something that's going to give him a reason to buy your property, right? I mean, if everybody was just buying a stabilized asset, you'd buy Class A and you just sit there and you do nothing. But, there's a reason that these groups come in and they want something to do. It's because they can increase the value to their investors, make their investors more money, and, sell and move on to the next project. It's funny. I bet that there are some multifamily groups out there who have owned the same property twice and done different kinds of renovations on it, just because those properties trade every 5 to 7 years. It's like almost, you could count on it religiously that every 5 to 7 years, these multifamily apartment complexes will come up for sale, because that's just the life cycle of these investments. I wouldn't be surprised if, over 35 years, you come back to the same kind of property.
Right. And people, when I tell people that all the time, they're saying, well, why are you teaching me how to do this? Because, there's only, so many in the city. Why wouldn't you just want to hold them for yourselves? Well, first of all, I can't buy everything in the city of Austin, right? The city of Austin has about 600 to 800 properties. So physically, I can't buy them all. But then secondly, exactly what you talked about. They're all going to trade. The average hold time for a multifamily asset is 3 to 5 years. And then they always go to me, well, why is that? Why are they always selling? Are there always problems they got to get out? No, it's the business model. There's two reasons usually that's going to dictate how long somebody's going to hold these things. Most of these deals are bought as syndications, almost all of them. It's very rare that you're going to have somebody buy a 50 to 100 or maybe a 400 unit property by themselves. They're usually going to bring in other investors. When you have other investors, the investors eventually want their money back and roll it into another bigger, better property. Right. So there's velocity of money. They want to continue to turn their money over. So you can't sit on it forever. The second piece of it, when you come in and you buy a new multifamily property, an apartment complex, you're going to, remember, we're talking about rehab dollars. You're going to pretty it up. You're going to address some of the deferred maintenance. And so let's say you paint it in year one, you put new roofs on it and everything. There is a lifespan for all of these things. Once you buy, you fix a lot of things up. Usually about year 3 to year 5, you're going to have to start readdressing some of these capital projects. Some of these big major systems are going to have to be looked at again. Maybe you're going to have to start doing some repairs to the parking lot. A parking lot, just repair jobs each year could be $10,000 to $20,000. If you have to resurface it for some reason, that could easily be $50,000 to $100,000. So you spend a lot of rehab money up front to make it better, to clean it up, to repair it. But then about 3 to 5 years later, you're going to have to start revisiting a lot of these things again. And that's the time when people will look to sell. They don't want to go out and raise a bunch more money from their investors that have already put a lot of money into this thing. They just sell, get money back into the investors' hands, and turn around and put it into the next property.
Yeah, I mean, you get the velocity of capital, right? If you're looking at IRR as your metric of return on investment, which I think is really one of the worst metrics you could look at, because it's the most easily juiced by anybody who's trying to do a deal, honestly, then, every year that IRR goes down, right? And so 5 to 7 years, you get in there, you add the value, you take some cash flow, you flip it for a higher value, hopefully. And that's about when you can maximize the returns for your investors, and then you move on to the next project. I mean, if I'm going to talk bad about IRR, I'm going to tell you too what I prefer to pay attention to: annualized cash on cash return and equity multiple. Because it all comes down to the amount of time that you do a project, right? I mean, I could give you a 50 IRR, but if you give me $100,000 and I give you, and it's a 1-year deal, it's very different than $100,000 over 7 years. It's just, I don't know, there's easy ways to juice that. You could have zero cash flow the entire project, and I could still get you a higher IRR based on the sale. So, but that's why I like equity multiple, annualized cash on cash returns.
Right. So let's talk about IRR. A lot of people are listening going, okay, I've heard the term, or some people are saying, I don't even know what the hell that is. I've never heard that. So it's internal rate of return. And don't ask me to break it down scientifically, because it's complicated. Nobody really that I know can do it. I'm sure there are a lot of brilliant people listening that go, oh, it's just, let me kind of give you
It's almost impossible to do by hand. It's incredibly difficult.
Right. So the IRR was designed basically to compare like types of investments. If I invest this much money in this project or this much money in this project, what's going to give me the best return of on my money?
Over time.
Right. An IRR is supposed to judge your return based on the time value of money and compounding. That's what it's supposed to be taken into consideration. Again, I know it as a macro or a formula in a spreadsheet. Don't ask me to calculate it. I know how to set up the table. I know how to put in the proper formula at the end to get the right answer. But that's what an IRR is. And where an IRR really comes in handy for me. Now, all of us have our own thought. Tyler, you don't like the IRR. I kind of like it more than you. Some people, it's all they care about.
Yep.
Totally fine. We all have our own metric that we want to see. That's why when I do a syndication that I bring to market, I always show them 4 returns. I show them the cash on cash, the total return, which is kind of also the equity multiple, the average annualized return, and the IRR, because different investors have different metrics that are important to them. For an IRR for me is anytime there's a very, very large value add component or it's a development where we're going to make some cash on cash returns while we hold it. But the big thesis is on this one is to sell it and get a huge return when we sell, because we increase the value so dramatically by taking a beat to hell property and turning it around, getting better tenants in there, getting higher rents for those units. So when you're dealing with things like that with a very large value add component, IRR takes that into consideration, because you get this huge chunk at the very end. Like you said, the longer it takes you to recognize that huge chunk at the end, if I can get you a $5 million profit at the end of year 2 with my value add, or it takes me 10 years to get that same $5 million profit, the time value of money, which is what IRR is measuring, it's just going to drag your IRR down because it took you longer to recognize the full return. So I hope that helped people. That's a very hard concept for most people to understand, but that's kind of sort of what an IRR is all about.
Yeah, the internal rate of return, I think that, gosh, it's so difficult. And honestly, for years, I just didn't pay attention to it. But when you get into syndication, you have investors that's all that they look at. So you really have to learn to understand it. So, yeah, I mean, I was going to try and start to explain how I look at it in my head, and I feel like I would probably just confuse people, so we're just going to not do that. If you're interested in learning more about internal rates of return, go to Google. Bruce, as far as like back of napkin numbers go, when you're looking at a project, is there a percent that you say, okay, I'm probably going to need a 20% down payment and 5% and everything else. And so I need to be able to bring 25% to the table for this deal. So going back to your $20 million example, I'm going to have to bring $5 million. I'm going to have to raise $5 million. Is that kind of do you have a back of napkin number like that?
I do. Now, on your first property, what I tell people, excuse me, is you're probably going to have to come out of pocket 35 to 40% on your first deal. Now, you might get lucky and get something that you only have to come out of pocket 25 to 30%. But remember, I told you, in most markets that I'm looking at right now, the average down payment is 30%. Now, as prices get higher and higher and higher, that's going to go to 35 and 40% before too long. I'm certain of it. But right now, I'm seeing about 30% as average, sometimes a little better, sometimes a little worse. So if it's going to be 30% for the down payment, your closing costs could run you 3%. So now you're at 33%. Your rehab could cost you another 3 to 4%. And there's another piece that we haven't talked about. That's operating capital. So all those things added up, your first deal is likely going to cost you 35 to 40% of the purchase price to take down. So if you're trying to buy $1 million property the first time out, you're probably going to have to come out of pocket somewhere between $3 and $4 million. So yeah, that's steep to think, man, I got to come up with almost half the purchase price. Yep, you do. But that's why you have good underwriting software, a good spreadsheet to make sure that you plug all the numbers in the right places to make sure you're thinking of everything. So, we talked about what the rule of thumb is for the overall cash raise, but let's finish up the last piece, and that's operating capital. And operating capital basically is your working capital, your readily available cash in a bank account, in my operating account for that project that I use to write the bills on a monthly basis. It really comes in handy at the beginning. Like, let's say that you take over a project and you haven't started collecting rents, but you have some bills that you have to pay before you start getting your rent. So let's say you take over on the 5th or the 10th. The previous owner has collected most of the rent by the time you get it. And so now you're not going to collect any rent for maybe 2 to 4 weeks. Well, until those rent payments start coming in, there's probably going to be a few things that you have to spend money on at the beginning. So that's where operating or working capital comes in very handy. But I use it as a threshold, not to fall below, because I always want to have reserve money in my operating account to make sure that if something weird just pops up out of the blue that I did not expect, I always have a safety net sitting there. So
Can
my
you elaborate on the difference between operating capital and reserves? Because we were talking about that this morning. We saw a group get into trouble with this, where they put all of their money into reserves and didn't consider operating capital. But I mean, I would imagine for somebody that's just now looking at this, you would look at those and go, how are those not the same thing? What's the difference?
Okay, so reserves is a very large bucket to me. Reserves is where I'll put my rehab money, right? So the money that I didn't get rolled into my loan to do some of the deferred maintenance rehab projects that I need to, I will put that in the reserve account. I will usually always, so I have, on every property that I do, I always have 3 accounts. One for security deposits. Whether your state legally forces you to have a separate account for those, you damn well better. You're just asking for huge problems if you don't segregate your security deposits for your tenants into a separate account that you do not touch until they move out, and if you have to write a check back to them because they left the property in good condition. So I have a security deposit account, I have an operating account, and I have a reserve account. The reserve account will hold my operating capital because I can move it over instantaneously. It's within the same bank system. I will have that there, and I'll have all of my rehab money put in that same account. So the difference between operating capital and reserves, again, will have a lot to do, for me anyway. Everybody can run it however they want. This is the way I do it. I put my rehab money in that account as well. And I have my operating capital. My goal for operating capital, my underwriting parameters are, I want 1 month's operating expenses, including my debt service. So all the expenses it takes to run this property on a day-to-day basis, plus my debt service, which is principal and interest. So 1 month's worth of all those expenses, I want as my operating capital, right? I don't ever want to drop below that. If I do temporarily, because I did have to dip into that reserve, because it is still somewhat of a reserve, it's your safety net. I need to bump that up as quickly as I can by maybe not sending out as much distribution on the next quarter, because I got to bump my reserves back up to an acceptable level. The other piece of this that so many people don't understand, they don't think about, they don't consider, there's something that I call negative carry. And what negative carry is, let's say you buy a property that's 50% occupied, or you buy, like what we do, we buy a lot of totally vacant commercial properties right now. Well, there's nobody in there, so there's nobody paying rent. So you're going to lose money until you get it filled up, because you still have to pay taxes, you still have to pay insurance, you still have to pay landscaping, keep the lights on, property management. There's all kinds of bills that just because nobody's living there, you still have to be paying those bills on a monthly basis. That loss until you become break even, that's considered negative carry. So let's say it takes you a full year and a half to get something built and leased up. Over that year and a half, you have to figure out, with spreadsheets usually, you're going to figure out and chart this out, how much you think you're going to lose every single month until you hit profitability. Whatever that total is for that 12 to 18 month period, you had better raise money for that. You don't just get to go to the bank, oh, we didn't have any profit this month, so I'm not going to pay my, no, they're not going to let you do that. You have to raise money to make all those payments while you don't have enough profit. That's called negative carry. The deal that you're talking about, Tyler, that's where they made a mistake. They had basic reserves or operating capital, but they did not have anything accounted for negative carry. So this project that they did, it was going to take them 9 to 12 months to lease this thing up. Well, how are they going to pay the bills until they're profitable? They had nothing raised for it. Nothing. That can't happen. It's impossible. The property goes under. So unfortunately, when people get into this situation, what they end up doing, you'll have people in the GP, or sometimes they'll reach out to the limited partners because they're stuck and they have no option. They got to go back for more money. So it's a really bad situation to put yourself in. And It's just asking to lose your property. So be sure your operating capital is 1 month's debt service and operating expenses. That's my rule of thumb. You can have whatever you want. I think that should be a minimum, but it also needs to encompass all of your negative carry because you have to have money to pay the bills until you're profitable. So that's the last of the four buckets that I really look at to decide how much I need to raise.
You never want to find yourself in a cash call. I mean, that's one of the worst places that you can be as a GP. You will lose your investors' trust. It's not a good scenario for anybody. I would say on the, so Bruce's metric is obviously for a relatively stabilized multifamily asset. So, when we're underwriting development projects or, heavy value add commercial properties, there's not really a good rule of thumb, right? Because you got to figure out, okay, how long is it going to take for this development to happen? And then we've got to figure out what are all the expenses that we're going to go through in that time period. So, the provisionary, we acquired it already. And we've got a note that we're paying and taxes and insurance, but we haven't even broken ground yet. So you have to go through and break down every single one of those expenses over 18 to 24 months to figure out what your carry costs need to be. And so, like Bruce said, I mean, it's critical that you have a very good spreadsheet that helps you do all of that. Shameless plug, Bruce's multifamily underwriting spreadsheet. There's a link in the show notes below. It covers all of those buckets so that you don't miss anything, right? I mean, it walks you through each step of the underwriting process to make sure that you're accounting for everything from, interest to pest control. And that you don't want to forget anything, right? Because the last thing you want to do is, again, have to go back for a cash call.
Right. And on the spreadsheet, it's got everything figured out for you. There's lots of formulas and calculations that it's all doing in the background for you to make sure you do this right. If you don't mess up the spreadsheet, a spreadsheet is as good as the person using it. There are a lot of unprotected cells. If you start screwing stuff up in protected cells, they're protected, but you can still get into a protected cell as far as I can tell. Now, I am not, deeply versed in PowerPoint. I mean, not PowerPoint, but Excel and Google Sheets. I know what I need to know for my own benefit. There's probably a way to lock a cell that nobody can get into it ever for any reason, but I haven't figured it out if there is. But if you start getting into these cells that are formula cells or populated from some other spot in the spreadsheet, you're going to screw this thing all up. So you got to be very, very careful. But so talking about that, and you mentioned overraise on your capital raise. How much? Well, I want to talk about that a little bit now. So the overraise for me comes in two different buckets. I will overraise for my rehab and overraise for my negative carry. So let's say I think I'm going to lose $1 million the first year while I get this property leased up, filled up, and turn a profit. It's going to take me a month to start generating free cash flow. So in that year, I think I said month, but in that year that it takes to get there, I got to figure out how much that loss is projected to be. Now, I'm always going to be conservative. So my spreadsheet has what is the loss, what's the sum of that loss for the year multiplied by 1.2. I always want 20% extra fluff, contingency money. Because what if something goes wrong that I didn't project accurately? That's going to happen.
And things go wrong. Yeah.
Right. Things are going to go wrong. They do for everybody. They always will. Your goal is to try to minimize the surprises the best you can, but there's always going to be a surprise that comes up. So whatever the negative carry is, the spreadsheet will factor that and add 20% to it. But then on the rehab front as well. On rehab, let's say I do the initial property tour with the broker. I come back and I think, okay, I think it's going to take about $400,000 in rehab dollars to fix all the things that need to be fixed because they're broken or in deferred maintenance, or all the things that I want to do to pretty it up to make it more valuable. The landscaping, maybe you want to pretty up the pool area, maybe you want to redesign the leasing office, whatever. All that comes up to say $400,000. I'm usually going to add $200,000 to that. And everyone's like, oh, that's ridiculous. That's 50% more, right? My goal when I buy these properties, I want to make an offer. And let's say I offer $10 million to buy this property. I go in and I start doing inspections after I get it under contract, and I find some things that I didn't think were going to be there. Right. So there's an extra $100,000 in stuff that I found. I thought the foundations were in perfect shape. I find out 2 of the 20 buildings are leaning a lot more than I thought they were, because I had a structural engineer come out and they told me about all this. So I get that bid back and it's $100,000. I'm like, oh my God, I thought it was going to be 400. I have in my numbers to raise 400. Oh, I have to go back and retrade or renegotiate that deal for another $100,000 off. So now I got to go back to the seller and say, look, I can't give you $10 million for this. I can only give you 990,000. No.
9 million. 9,900,000.
Yeah, 9 million. It helps if I'm whiteboarding behind.
Man, you really do need some coffee.
But
I was just bragging on you like 2 shows ago how good you are at just doing numbers in your head.
Yeah. So then I got to come out of pocket that $100,000 or get it retraded. That's why I come out of. I mean, that's why I overraise. If I think the construction in the rehab is going to be 400,000, I'm going to bring in 600,000, sometimes even more than that, because I know there are going to be things that I don't find even during my inspections. I might not find things until I own the property and I'm actually seeing the property live and breathe. If I don't have enough money raised, well, what am I going to do? You know, first of all, let's go into the negotiation part when you're trying to close the property. If I go back to the seller and say, look, I need to get $100,000 credit or I can't buy this property, they're going to be pissed. You're showing you don't have your shit together. You're pissing me off. You're irritating me. We had an agreement to buy it for $10 million. Now you're going to try to buy it for $100,000 less. See how I did that time? I didn't try to do the math. But you're just going to irritate them. So I always bring extra money to the table. And I tell people when I'm buying from them, when I'm bidding to be the person that buys it from them, I am raising significantly more than I think I need, because I do not want to come back and renegotiate with you. And that goes a long, long way. So that's why I'll always overraise for my rehab, and I will always overraise if I'm in a negative carry situation. Always.
It's better to be conservative on your underwriting and miss out on a deal than to get too aggressive with your underwriting and get stuck in a really bad deal.
Yep.
So, I mean, that's the philosophy that I take with that. So, Bruce, I think for the next episode, we've been talking about doing this for a while, but I feel like that's kind of the next step in this little saga here. Let's dive into your underwriting spreadsheet and show people how that works, because I've done a screen share on how to use the commercial version of it, but we haven't done one for multifamily yet. And so, after talking about the cash raise and everything that you need to take into account, I think it just makes sense to do that next.
Yeah, so, the full course is it's long. There's a lot to go into. But what we'll do, we'll just give a high-level view of what all the things are. And you might not use our spreadsheet. Totally fine. You're going to use your own. But they're all made up of roughly the same components. So we'll go through what all the different things are that you need to be thinking about in an underwriting, how to find those numbers, how to come up with those numbers. So we'll do that. That's going to be that'll be a really good one, especially for the type B personalities, the engineering spreadsheet brains listening. That'll help a lot.
Yeah, it helps me keep my thoughts organized, because there's so much. There are so many details in every single project, and if you're anything like me, I'm high level. I'm big picture. I don't have time to think about we should have accounted for pest control. So the spreadsheet makes sure that you do that. Well, don't forget, join us live every Friday, 10 a.m. Central. Come in, heckle me and Bruce. Ask your questions if you have anything about commercial or multifamily properties. And next week, like we said, we will be talking about underwriting multifamily. We'll be diving into Bruce's spreadsheet. If you're listening on the podcast, I would still tune in. It's going to be very valuable just talking about what each metric is and how we account for it. So we will see you guys next week.
Well, hang on. Subscribe, and share, right? Subscribe, and share. I hope we're providing value that you guys find a lot of value in, right? So if you do, please share this, subscribe to it, keep on top of it with us.
Yeah, if you enjoyed the episode, share it with a good friend. See you guys next Friday.